for the mortgage people, one of the consideration when it comes to a mortgage, you must have like a stable source of income. So in most of the cases, this applies for those people who are employed or someone who have a fixed source of income, because they know that their job is quite secure and they can be able to get those repayments at a particular period of time. Hi guys, welcome again to another episode of Financial Literacy. My name is Jane Dishu and I'm a financial advisor. Thank you so much for all of you who have been supporting my content. If you are new here, remember to subscribe to this channel. Make sure you like, comment, and also share, and turn on the notification bell so that anytime I post this content, you will be notified. Disclaimer, if you're running a business, a mortgage needs you to have a very calculated move, and you need to have planned and even decided on how your business patterns run, because I know the instability of income, I know the instability of maybe contract jobs and such things. So for mortgage, most of the time you'll be required to have a fixed income. It's quite easy for you to repay. Some of the considerations that you need to consider by the time you're getting a mortgage is you might need to give like a down payment, or maybe what we call the deposit. The down payment will surely determine like maybe how long you're going to be given to repay that particular loan. So you need also to plan. And I have seen some few people make mistakes of, you go maybe to your bank, you borrow a down payment, and then on top you get a mortgage. Remember, you're going to service 2 loans. So I usually recommend save for your first down payment. It usually gives you a strategy on how you can be able to balance on paying off that loan. Because if you were from a saving plan, the amount of money that you were saving in that saving plan to raise your down payment is the similar amount, or you're just going to add a small amount to repay that particular loan. So I usually advocate you don't get a loan for your down payment. Actually make sure that you save. It's easy for you. Another thing you need to consider when it comes to a mortgage, you need to consider the term period. So if you can be able to give a lot of money as down payment, it's going now to give you maybe a lesser period of time to choose from, and also the amount of money you are going to pay. The period of loan repayment or the mortgage repayment is very important in this case, because the longer you pay that mortgage, of course, the more the interest you'll have paid by the period will be done. So I usually tell people, if you can be able to pay your mortgage within 10 years, and the longest to be 15 years. I don't like those mortgages where people pay 30 years, 40 years, 50 years, guys. If you're already 20 and you're paying your mortgage for 50 years, it means you might not enjoy that house by the time maybe you are done with your retirement, or you're done in this world. So I usually recommend you pick a smaller period of time. Definitely, if you pick a smaller period of time, it means that you'll be paying a lot of money as maybe the repayment amount. But let me tell you, if you can be able to chunk and be able to pay lump sums and deposit and pay off that mortgage earlier, I know you can be able to get the consideration of saving the interest on top of it. The other thing that I really want you to consider when it comes to mortgage is the interest. So we have 2 ways you can be able, 2 interests that we have in mortgages. We have the fixed interest rate and we have the variable interest rate. So the fixed interest rate is where if we're giving you a mortgage at 14% and we're giving it for 30 years, it doesn't matter if we have economic changes. It doesn't matter if the inflation rate goes up. It doesn't matter anything. You're going to pay that loan at 14%. I usually recommend this option because you already know it's pre-planned. You know, like your deposit will never go high. So it's something that you can be able to work around. And in case you even get a salary increment, you already know that it is not going to be affected. The other variable interest rate, unless they have a plan, I don't buy into those mortgages where they tell you that we don't know how this is the interest rate is going to grow, and they tend to be somehow selfish with the information, and they tend to tell you that we can evaluate the interest rate depending on the economic changes. One of the things, if a company have been in the market for quite some time and they have been giving these mortgages, they usually have a way. They can be able to tell you maybe your interest is going to vary with 1% after 1 year, or 2% after 2 years, or 5 years. They can give you at least a projection of how much you'll have paid at the end of the period. So the variable interest rate have found so many people in the repossession power, and so many people have lost even their money and their houses, because it gets a point where you cannot be able to raise double the interest rate by the time you were starting. Considering the way this interest rate is growing, it's not the same way your income is growing. So at some particular point, you might not be able to pay it off at the end of the day. The other thing that you need to consider is if there are any extra charges at the end of the period when you have already paid for your mortgage. If you need maybe to pay for title deed certificates and other management fees and other transactional fees, you need to be to get that communication before, so that you avoid getting to understand that after 10 years you are asked maybe for $500,000 to clear your maybe title deed, or to make other other deposits which you are not ready prepared. So make sure that this is something which is discussed before you even get into contract. First consideration when you are considering to get a mortgage is, in case of you are not able to pay off your loan again, or your mortgage again, like what happens when it comes to the repossession terms? Are they going to maybe give back maybe the amount of money you had contributed, or are you going to lose your deposit and everything else, including the house? Because I have seen some of these mortgages, mostly the bank mortgages, you're going to lose like everything. You're going to lose your contribution, you're going to lose your down payment, and you're going to lose the car, which is quite expensive. So you need to know the exit plan, or maybe the emergency exit plan, or maybe how they carry out their repossession. Discuss these terms and conditions. Another thing, it's not only you losing your job or not being able to raise the amount of money you need to pay. You also need to discuss, in case maybe you are permanently disabled, in case you get into an accident and maybe you cannot be able to function again, or in case maybe you are diagnosed by a critical illness, or maybe you have mental problems, or even in case of death. Like, just get to understand the repossession terms, just get to understand what the insurance covers. Because I know I have seen families or people where someone died and then maybe their insurance terms did not have a life cover. So you lose your mortgage, and you also, because it did not cover. So in case this contributor dies, the bank comes for that house. So you need to understand, these days we have something we call credit life. This is like an amount of money that goes to life cover when you are on credit. So you need to understand those basics, ask the hard questions, understand even the critical illness. It doesn't have to be death. Understand the critical illness, mental sicknesses. Just understand all those things, in case of even in case maybe you have maybe some court proceedings, or maybe you were jailed or something close to that. Just get to understand the repossession powers, and get to understand, just in case, if maybe you were doing maybe rent to own mortgage, you don't have to inconvenience your family in case you have these things or these emergencies happening to you. Just get to understand the terms and conditions at the end of the day. The last thing, make sure that you can be able to negotiate the best repayment plan and the interest rate. Make sure that you are getting the upper hand and the best discounted interest rate at the end of the day. And guys, I hope you enjoyed this video and you learned something, and we are going to make use of the borrowing powers that we have, and we are going to grow ourselves at the end of the day. And until next time, thank you so much for watching.